Good afternoon, everybody. Thank you very much for joining us today. I'm super excited to have two very well-versed people from the ecosystem on a subject that I think is actually quite interesting, especially now. We're discussing, is now the right time to exit, and why all startups should be considering all different types of options. I've done several of these webinars, and it's amazing to hear many of the VCs talking about how now is an opportune time to potentially merge. I've heard that so many times, I'm not quite sure why, and I actually wanted to dive into that. So I have the pleasure of having two people who are very well versed on this subject, very familiar with the region, but also now actively getting involved in the MENA region. So I'll also be fascinated to hear their perspectives. Zach ran VP of Corporate Development at Careem, which actually included M&A. Not that I'm going to dig into that deal specifically, but he has a huge amount of experience on what that means, and was previously a partner at Lumia Capital, who are also early stage investors in Careem. And he's joined by Joel Ayala, who also led corporate development for a tech company in the US before joining Lumia. So has a huge amount of experience in both of those, in this field specifically. They are both partners of Class 5, who are an emerging market VC, who now are becoming more active in the MENA region and have huge amounts of experience in emerging markets. And later on, I'll ask them a little bit more about that experience of how emerging markets can relate to the region. But I've already briefed them, and I just want to kind of dig straight into this. And I guess to kind of set the scene a little bit, you both must have had experiences with previous economic crises, economic environments, and how that pertains specifically to kind of the venture space. To give everybody a little bit of background, I mean, what have you seen in terms of historical trends that may be applicable in terms of crises and crashes to what's happening now? Maybe we'll start with you, Joel.
Yeah, so I think, look, it's we're obviously living in very interesting times, but I think these things do happen in cycles. So what has happened before will happen again, and we're seeing that in terms of investing. So in terms of where we've looked at these cycles and where we've invested in the past, we've actually had the opportunity to invest in a pretty deep recession, actually, in a country in Brazil, after all the turmoil that happened there with the elections. The economy was shrinking, things were going crazy. It was actually in that period that we actually made 6 investments in the country. So I think from an investor standpoint, with these crises, with these recessions, these downturns, come opportunities to also invest in founders that are building businesses for the long haul, but also companies are coming up with solutions that are addressing fundamental issues, right? Providing value to consumers or businesses that are really, resonating with consumers and businesses across, the market. So I think while there are obviously obstacles, whether it's fundraising or, hiring or whatever it may be, they also present pretty great opportunities for the startups and founders themselves.
And I'll add one more thing in terms of crisis M&A activity. If you look at the patterns from the last, financial crisis, sort of 08, 09, there were a number of large acquisitions. Probably the 2 most famous were Oracle buying Sun Microsystems and Amazon buying Zappos. A lot of the activity, though not even both examples that I just gave, was driven by bargain hunting mentality. So, we'll talk a little bit more about the current environment. You'll see a lot of parallels. But overall, I would say these crises tend to bring buyers to the table because they're looking for bargains. They're looking for opportunities for M&A that they wouldn't have had during a different time period.
Firstly, I want to say thanks, Zach, for joining us, because I know it's very early and you're probably sipping in the coffee. Where are you right now? LA or Silicon Valley or?
So yeah, I'm actually quarantining in LA, though I'm based in San Francisco. I know it's very complicated. The important thing is I have to wake up at 5 in the morning.
Yes, and we thank you for that, and really appreciate that.
Of course.
Zach, maybe if I jump with you, I mean, like clearly you have this emerging market mandate. I'm always fascinated because I realize that you can't really compare the MENA region to the US and Europe, which are much more developed markets. When you look at some of the emerging markets, whether it's South Africa, whether it's Africa, whether it's Southeast Asia, how would you characterize, let's say, one or two characteristics of similarities that you see the MENA region has to those? And what are some of the perhaps nuances or differences? Forget M&A, just kind of ecosystem to start off with, and then we can come on to deep diving into M&A.
Yeah, so it's interesting. I mean, the markets that we focus on, Philip, the markets that you mentioned, I would say share a lot of characteristics in common that not all emerging markets do, right? These are generally, by and large, middle income regions, right, where consumers do have purchasing power. We're not talking about some of the poorer countries in sub-Saharan Africa or South Asia. We're talking about countries that, from a socioeconomic standpoint, are far from sort of the bottom of the development cycle. At the same time, from a tech standpoint, they are, right? So we're talking about countries where if you look at a basic metric, e-commerce penetration, usually we're talking about low single digits, right? Low to mid single digits. What we see is a very big parallel with China, right? Where you had low single digit e-commerce penetration as a percentage of retail spend that went to about 25% in about 8 years, right? And it did it because the purchasing power was there, the infrastructure eventually got built, and all of a sudden, you saw consumers very quickly shifting their behaviors online. So effectively, the markets that we're focused in are markets where, again, there's purchasing power, but there's a huge tech opportunity and a lot still to do. And what's interesting is these are all different cultures, they're different languages, they're different histories, but from a tech standpoint, they actually look an enormous amount alike.
Interesting. And Joe, anything to add on that, on where you see maybe some differences in the MENA region versus some of the other emerging markets rather than the similarities?
No, that's a good question. I think when it comes to the differences, there's a couple handful that actually make this market a unique market for us to invest in. So one is actually language, right? When you look at Southeast Asia, there's actually about 8 dominant languages across the countries. Even Latin America, where people assume most people are speaking Spanish, a third are actually speaking Portuguese, right? So your whole Brazilian market is a different language. The Middle East has a very unique perspective in terms of being able to have a unifying language in Arabic that you can scale around. When you look at the age group as well, it's fascinating. The region itself is uniquely below the age of 30 on average, right? So the average age is about 27, and that means you have this large potential user base that's young, that's digitally savvy, that's ready to go online, that you can unlock very easily. And then when you look at kind of places like the UAE and Saudi, what's even more interesting is when you look at metrics like time spent online, social media usage, internet penetration, smartphone penetration, it's actually higher than the US or China. So you have this kind of perfect situation of having this young population that is ready to go online, is using this. And I think that's where the opportunity is for venture in the MENA region to tap into this large user base that's coming online.
Here we've seen that there's a lot of governments that are really focused on this. I mean, you can see it's top of their agenda and it's pushing. Is that the same in other, is that a global phenomenon now that governments are basically trying to focus on technology as a potential solution to things like employment and digitalization of economies, or is that something that's particular for the MENA region?
I would say it's probably something, at least for when it comes to the GCC, is different than a lot of our emerging markets. I think the government has done a great job of pushing initiatives, being a proactive stakeholder to this and helping to create these ecosystems. I would say Singapore also has done a great job of that. But outside of that, I think, you look at other markets like Mexico, Brazil, Indonesia, it's still, very much in the early days of government involvement and getting these ecosystems off the ground. So I would say the GCC in particular has been kind of a great leader in helping to bring these trends on board.
Cool. So, okay, let's jump into this M&A question. Like I said, I've spoken to many VCs and investors, and they're all saying now is a right time for M&A. So excuse my naivety. Why is it such a right time for M&A? and who should be considering this? What type of startups should be considering M&A or exit? As you said, you should name it more broadly, exit opportunities, than M&A activities in the current environment. Maybe Zach,
Yeah,
I don't know if you have a...
No, I'm happy to sort of take a first go at this. But look, in terms of the current market, there has been a decent amount of activity, right? We've seen everybody from SoFi to Cisco to Microsoft, actively making acquisitions, since really the crisis became pronounced in the last sort of month and a half or so. But the environment continues to change, right? I would say there have been probably three considerations by and large in the M&A market based on our conversations with, M&A leads at corporations, bankers, that has generally kept the environment still a little more restrained than what we're all sort of expecting to see. I would say one is a lot of these companies, especially more mature companies, do have, rely on debt to do a lot of what they do. Less so in tech acquisitions because you're not buying out companies with cash. But up until recently, credit spreads were pretty wide, so people couldn't necessarily access the financing. There's a more logistical issue too, is that, if people want to do major M&A projects, it's very challenging when you can't sit together in the same room and discuss strategy. So, as much as sometimes we forget these logistics issues that we're dealing every day, they also affect, Fortune 500 companies, all sorts of potential buyers all around the world. People are reticent to make big M&A without sitting down in the same room. And then finally, and this is probably the biggest issue, is there's a discrepancy on price. So, Philip, you mentioned that a lot of people have said to you that now is a, very sort of potentially could be a very active time for finding exits. Now, when we speak to buyers, the reason for that is they're out bargain hunting, right? Fundamentally, the world is very uncertain for them. They're nervous just like we're nervous, right? But, they're very much willing to put that aside and do deals if they can get great deals that they couldn't before, right? So effectively, there's this discrepancy on price where sellers are inclined to think that this is a blip, that the price they had 2 months ago is the price they deserve now, plus or minus. Buyers are saying, stocks have moved in X direction, depends on the day, and we deserve a discount for the uncertainty and for what's happened in the market. So effectively, this is an exciting opportunity, I would say, for buyers. I think there's two types of sellers. There's normal sellers and distressed sellers. I think distressed activity will happen. Will probably even pick up. This is people who are forced to sell, right? But in terms of normal sellers, it's people will have to make compromises in most cases, not all cases, but in most cases. Again, this is different sector by sector. People who are in the grocery delivery business right now probably won't have to make any compromises, quite the opposite. But I think, that you have to incentivize buyers to get excited, and everybody we speak to, they want bargains, right? Yep. They want bargains. They're very excited to be active. And some of them, like, again, Microsoft and Cisco have done multiple acquisitions, but they want bargains.
Well, I mean, let's bring it down, Joel, if you don't mind. So obviously cash is king. I mean, although you could use stock options and you can do mergers from that perspective, cash is king. If you are a startup, let's look at it from a startup's perspective rather than a corporate, because obviously, like you said, that's a buyer's perspective. You could also do the merger side of M&A and potentially acquisitions. So assuming you're a well-funded startup, you just got a funding round and you are looking for those discounted deals or for opportunities that may not have presented them during boom times. I mean, obviously there's different reasons you may do this. It could be a vertical integration, a horizontal, or geographical. Can you go into some of the logic, if you're a startup founder, that you should be thinking about when analyzing your kind of market to say, yeah, this is something that, I guess ultimately two questions. What type of startups would you be looking at? And what's the logic by which you should kind of fundamentally go into thinking, this is something I should do rather than growing organically?
That's a good question. I think the one piece we can also add to that is acqui-hires, which are happening at a very fast pace. So with acquihires, usually a startup is looking at another startup that may be smaller, maybe earlier in their life cycle, for some reason or another wasn't able to scale, and they're looking to tuck them in. And a lot of times you kind of see this happening in the sense of a tech, kind of a tech need, right? This is a team that was very technical, had its sector expertise, and you're bringing them in to help you facilitate a product or something that you're looking to accelerate. So we're seeing more of that happen, and that's something that I think in these climates will happen more and more, because there are folks who are not getting funded, and there's great talent in these companies and they want to stay together. So that's one piece there. I think when you look at the companies themselves in terms of thinking about horizontal or vertical or geographical expansion, it comes down to the founders, management, the vision, and also understanding the synergies that can be derived from these M&A opportunities. So I'll go into a couple examples of how some of these founders are thinking about it and what's actually worked in the past for some of our companies. If you look at a lot of software companies, some of the main drivers of growth and profitability are retention and being able to upsell, right? And when you think about M&A opportunities, what's really interesting for them is vertical integration, right? So if you're a software company, how do you get into your customers' inventory, into their payments, into their supply chain, really ingrain yourself into all the things they're doing, right? So there's opportunities to potentially acquire products that can help you go down the vertical chain, which will, one, increase retention, but also there's this term that gets thrown out there of landing and expanding. That's something that a startup can do if they have other products they can offer, right? An upsell. So for a lot of software companies we've invested in and others we've seen, that's been a successful strategy. And that's something like Oracle does all the time, right? If you look at Oracle, they're constantly buying new products, verticalizing them and upselling them. So it's a strategy that's worked. When you look at some marketplaces, there's obviously network effects that are super important, right? Some marketplaces having supply density can help you win, can help you create network effects, right? So when you're thinking about horizontal expansion, that can make a lot of sense, right? If you're 20% of a market and you potentially can pick up another 10 or 15 with an acquisition, that can drive more density in your marketplace, more of a flywheel effect. These things can kind of make sense. Geographically, I tend to believe that's probably one of the harder ones. And usually you're seeing startups that are pretty well established, have a well-oiled machine behind them, have a product and tech team that can scale, that are starting to look at these opportunities. Companies like Uber with Kareem, right, where it made sense to potentially expand and consolidate geographically, and they have the capabilities to do so, right? So that's one where you tend to see some of these more mature startups throw their hat in the game. I think taking a step back, I think the advice in general would be for founders is to think long and hard about it. Take a break, take a breath, talk to your stakeholders, talk to your investors, do your homework, think about what you're about to embark on. And I think Zach will agree with me here, but the hardest part about M&A is not necessarily drawing up on paper a deal that makes a lot of sense. It's actually the post-integration part, the people part, putting that all together. How do you get that to work and jive post-integration?
And you mentioned investors, and I'll come to Zach in a second, but is it the role of the investors to push startups to potentially look for these opportunities? I mean, can you support in that exercise? What's the investor-founder relationship when it comes to potential M&As? And how does that relationship work? I mean, are they apprehensive of it because there's potential dilution of it or use of cash? I mean, I've never done it myself, so I wouldn't know. But as investors, are you encouraging of it, or are you kind of cautious of it?
I think, look, it depends. I mean, we've been in situations, both Zach and I, where we've been very involved with companies in their acquisitions. And, that's been part of the strategy of how to scale and how to, go into different verticals. And then there's startups where, that it makes less sense because we're like, well, one, you may lose focus on the core product, but then it also is a capital intensive endeavor, right? So there are situations where it probably makes more sense. Also depends on the founder and the management team. Are they equipped to do this? Do they have the right infrastructure internally in place to get this done? Because it is a big product lift. It's a big tech lift. It's a big finance lift. So sometimes some of the younger startups aren't ready to do it yet. Some of the startups that are scaling are maybe focusing on certain verticals and not able to execute on integrating something else. So, it kind of depends.
Yeah, I mean, I think,
Zach,
one quick thing to add is, there's just so many different flavors of VC investors. We've all had different experiences. I think you'll usually find, folks like Joel and I who ran corp dev for multi-billion-dollar organizations, we tend to be cautious because we've seen how hard M&A can be, right? We're always very supportive of our companies. We always put our full resources and efforts into helping them have a great transaction and integration. But we'll always preach caution. We have other people who've had amazing, just certain amazing one-off luck in the M&A space, and they'll tell all their companies to basically consolidate, right? So a lot of it is just there's different flavors of investors. I wouldn't genericize, what we think, but of course, the best investors will always be supportive and will always help you once a decision has been made.
So Zach, I'm going to come to you because I think it's fascinating. Obviously, you have this huge experience with Careem and Uber. Let's talk about it from the flip side, not the acquirer, but the company that's in the current environment, let's say, or even in the best environment, potentially looking to be acquired and considering speaking to their competitors because they think there's a perfect fit in that opportunity. When do you approach them and how do you begin that conversation? It's a very emotive and ego-driven conversation because, clearly, egos are going to be involved on both sides. Then you go into negotiation. I'll come to ask a question on that specifically. But trying to take ego out, how does a startup that may be distressed or just looking to exit in a good time approach a competitor to build that relationship? And how does that conversation evolve?
Well, it's a good question, Philip. And I think there's an ideal circumstance and then there's a less than ideal circumstance you can be doing this under. In the ideal circumstance, look, there's a cliche, but I believe it, right? They say good companies are bought, not sold, right? More often than not, the best companies, or at least the companies who have the most options on the table, aren't out there appearing to proactively sell themselves, right? Having said that, great founders will actually be selling themselves all the time. The market shouldn't know it, right? So, I think the best advice I can give is it's never too soon to build a relationship with your competitors. Yeah. It's awkward. It's weird. You never know exactly what you can disclose to them, safely. And I'm not overstating, I've not sort of tried to understate how hard it can be. But overall, there are chances to reach out, to meet at, at conferences, at various occasions, and build that relationship. And I think there's two reasons for it, right? One is, you want your competitors, and not just your competitors, but other potential buyers to get to know you, right? To become comfortable with you, and to understand the value of your business. At the same time, something that Joel touched on is, if you want to have a successful, post-merger process or even negotiation process, it's important for people to get to know each other so that you can have a less confrontational and more constructive negotiation when the time comes. So the answer is, in ideal circumstances, you're always selling yourself. And by selling yourself, we don't actually mean selling, we mean getting to know the relevant potential buyers over a long period of time. That's not always possible. It's not always how it's done. That's the ideal circumstances. I think once things become a little more accelerated, either because the founder wakes up one day with a change of heart, maybe the business won't be as big as they thought, maybe they had personal changes, maybe they're worried the business is at risk of becoming distressed, you may have to throw those assumptions out the window, at which point there's less of a playbook here. You need to get in touch. And obviously the best way to get buyers to be aware of you in those situations is not to just ping them directly. That tends to smack of desperation, but you can always have your friends help out, right? Your investors, other people who may know them, and try to be a little cooler about it. But basically, under ideal circumstances, you'd already have a pretty good relationship with these people.
So it's a bit like dating. You just have to play a little bit harder to get.
Yeah, absolutely like dating.
I want to make sure that if people have any questions, please send them through. I have plenty, but I want to make sure that if anybody has anything specific that they would like to ask, we'll get to them in a couple of minutes. So please shoot them through. A couple of interesting things on that point. Is there a value in hiring a banker to do the selling for you? And do you need it to be at a certain stage of growth to be able, number one, to afford it, and for it to actually make any sense? I don't know,
So you
Zach,
want
if
to
you would
take?
like to,
Oh,
or
sure.
whoever.
No, no, it's okay. I'm just talking so much. I feel like people are talking for me. I'll take this one quickly. Look, Joel and I have both
You like
once.
bankers more than I do, so.
Yeah. No, I mean, look, we've both worked in banking before. I don't think we have any illusions about bankers being able to, work any sort of intellectual magic for you. Bankers will promise you the world, and it's very rare that they can deliver, right? Your asset is what is the main appeal here, not the banker, right? And oftentimes, what's more, if you hire the wrong banker, they can actually make the deal process worse, right? Not usually, but I would say that if you have the right banker, um, the value I see first and foremost is that they can sit between all these different parties and all these different egos and smooth over the transaction. So in other words, right, if the board is upset about something, rather than management team going in front of the board, the banker gets to sit in the middle, take a little bit of the heat, and keep all of the parties a little bit warmer and back channel with each other, right? So ideally, if there's a buy-side banker, a sell-side banker, everybody's back channeling. The parties are actually purposely removed a little bit from each other, and it actually reduces tension. And you can sort of throw the bankers under the bus and use them to absorb all the tension and negativity in the process. Honestly, as ridiculous as it sounds, I actually think that's their main role. I think the other thing too, look, if you're a relatively early stage company, you don't have experiences with sell-side processes. This stuff isn't rocket science. There's a book for how to do this, right? In terms of just running processes, whether it's just with one buyer or multiple potential buyers. Bankers have done this 1,000 times. It's very easy for them. So I think in summary, don't expect them to blow your mind with new insights about your business or about your buyer. It's more pedestrian stuff, absorbing flack between the different parties, helping to run a process. I would say the best of the best bankers, especially some of the like top bulge brackets and the top elite tech boutiques might have relationships with your buyer too. 99% of the time that won't be the case, but when it is, that can be valuable because then they can actually help you navigate the organization, tell you how it works, but you can't always count on that. And bankers will always tell you they do, but you have to check.
Awesome. I'll get to questions in a second. So if you have any, please do shoot them through. Joel, an interesting one for me. Two scenarios, and what's your view on them? A startup comes and tells you they're about to M&A with a startup, pre-fundraising to make themselves a stronger proposition. And second scenario, I need to fundraise X amount, and I will use a proportion of that cash to do M&A activities to grow geographically. As an investor, do you have any views or thoughts on those two specific scenarios as someone that would be investing in a startup?
Yeah, I mean, I think both add complications, but there's also upside to it, right? I think when you think about acquiring a company and then going to fundraise after that, right? There's a lot of things that have changed, for the company going into that fundraise. One is just maybe the capital structure of the company. Did they raise that equity? Did they use a lot of cash to do it, right? And then thinking about dilution, the team dynamic, all that stuff. What does the product look like? How's that integration going, right? There's a lot of things that kind of have to move together when you make these transactions and packaging it all together for the fundraise, right? And from an investor standpoint, you need to spend time understanding what that means for the business, right? So not only do you look at the pro forma numbers, which are the combined entity numbers, right? You have to spend time understanding the two businesses, right? What is the core business growing at still? What is the organic growth, the organic retention? What does that look like? And what do the two businesses look like together? So it usually creates a little bit more homework for the investor to actually go in, underwrite it, understand what you're really investing in. Because I do think, I've been in situations where we've gone from about 10 million of ARR to 50, 60 million overnight, where the business was completely transformed because we bought a company that was much larger than us and integrated it into the core offering. It was tough for the financial sponsors to really kind of dig in and understand what that looks like, right? Because what you end up underwriting is what does the potential combined entity look like and what's going to be driving that growth, right? So there are some questions that come with that. On the second scenario, it's an interesting one, and we see it every now and then, is when the startup comes to us and says, hey, I have an acquisition target, I have something that I'm looking at, and I'm raising capital around it. I think that story ends up being a little potentially easier to underwrite if it's a standalone acquisition. But if it's tucked into, hey, I'm raising my Series B, and as a part of that, I'm going to be using 5, 10 million to acquire a company, it's a little tougher to kind of wrap your kind of hands around what that looks like. Is that great use of cash? What dilution am I going to take on the other side of that, right? How does this all kind of come together? So we have seen some scenarios where the acquisition made a lot of sense. We spent time with management and the team getting to understand the dynamics, running through the math, and there was a clear case for raising more capital to do the merger. And then I think the more vague cases of, hey, there's a couple opportunities, we're going to raise a little more capital to do it, are tougher to underwrite as an investor. It's just, a lot of it is a little bit of a leap in faith, but that they turn out sometimes to work well for the business, and sometimes be drags on the business or shift management focus away from the core product offering. So you never know what you're going to get.
Very clear. So we got a couple of questions here. It's quite interesting. What's the best way to manage divergent views at board levels when it comes to M&A? Not sure which one of you would like to take that.
I can take that one. There's a couple of instances that kind of ring to mind on my end. I think, look, it's important for the founders to always maintain an open line of communication with their board members and stakeholders and shareholders. And the reason I say that is, if the first time they're hearing about a lot of this stuff is at the board, you can expect there to be different views because people process things different ways. You need to be having these constant conversations with your board members, getting their insights, making your case as well, right? Keep them in the loop as to your thought process in this, and create kind of some stakeholder management when it comes to these issues, right? So I think you have to be radically transparent, be constantly communicating your position, helping them understand your pros and cons of doing this and how it's going to affect the business. Because I think the more you're able to do that, the better able you're going to be in terms of aligning those board members when it comes to making that decision. But obviously different personalities, different dynamics can always make it complicated. But I think transparency, communication are super important.
There's an interesting question here. It says, I'm a seed stage company. We have a term sheet agreed, low dollar amount, low valuation, COVID round to get through it, but have been approached for an M&A potential. Should the acquisition and investment valuations be similar range, or is there any difference in valuations given the different forms?
I mean, I'll take a crack at it, but Joel, I actually want your opinion because I don't think there's a ton of data out here on this, because it's not like M&A offers that are not accepted get published. What I've seen in the past is sort of the opposite of what they teach you in, actually it's not true. What I've seen in the past is actually exactly what they teach you in Finance 101. Typically a term sheet for an investment I've seen is usually a lower value than an M&A offer at any given point. Textbook finance would tell you that there's an acquisition premium that buyers are willing to pay, right, to get your company. I don't have a large enough data set. I mean, Joel and I have been in venture for the better part of the decade, but it doesn't mean that, we have thousands and thousands of data points on this. So from what I've seen, I would say M&A offers tend to be lower than term sheets. There's certainly a textbook finance explanation for why, in terms of control premiums being paid. I don't think that's necessarily the actual reason, and I couldn't tell you for sure. I would say, look, from the founder, let's forget what should be what. You have to ask yourself, what's your expected outcome, right? Do you think if you take, 20, 30, 35% dilution right now for less money than you wanted, that you can still build a big enough business over time to make it worth your while, right? Again, like, I think your decision making shouldn't be driven by what should and shouldn't be correct. I think your decision making should be driven by what's best for you. I would say if you should use that M&A offer to negotiate up your investment term sheet,
Yeah.
right? You don't have to necessarily tell them, depending on how far you are in the conversation and who the person is, you could tell them who the offer came from, or you can just allude to it vaguely. It depends on the circumstances. But overall, I would say, A, think about yourself, not what should and shouldn't be correct, right? B, I would say use it to negotiate up valuation. And just for the record, I've seen M&A offers typically come in higher than financing offers. Joel, really quickly, do you agree with that? Have you seen it differently?
No, I think I tend to agree with you. I mean, the only edge cases might be like super early on where someone may be willing to offer you like an all cash deal. And, if you haven't raised any money and you're the founders and you own 100% of the company, maybe 50 million early on is, much better than 100 million term sheet because, you're taking the whole thing home. So I've seen some of those small edge cases here and there, but I would largely agree with Zach.
I mean, ultimately, for what it's worth, in my opinion, is that it's a free market, right? So whatever somebody's ready to pay you is what they're ready to pay you. It's so if somebody's ready to pay to buy you out at a much higher valuation or lower valuation, it's a buyer's market. So that's very conscious. I'm fascinated to get your opinions on something that is widely talked about here in the region. There is an obsession with unicorns, and that's number one. And then the second one is an obsession with IPOs. And I think there's a lack of understanding, lack of understanding because we haven't had them necessarily as much, and that the capital markets here aren't as developed as they are elsewhere, of what it takes for a startup to get to IPO. Can you share some of the insights and logic and potentially share some of the insights, Zach, from Kareem, as to what it actually takes? Because no doubt there were discussions had, and I don't need the details of it, but what are the broad things you need to actually try and achieve to be able to list a company, and why it is so hard and far and few between? And I guess, how long do you think it'll take before we start seeing that as more common activity here in the region?
Joel, you want to start, and I can add some Kareem color?
Yeah, I'll start. I've gone through one of these before, which has been fun. But look, I think the reality is, to put it all into context, let's take like the software market in the US, which is probably the most robust kind of path towards IPO in the tech space, right? The typical company that's going public has about 100 million in revenue, is essentially break even more or less, and is raising about 100 to 150 in their IPO, and it takes them 10 years to get there. That's what the typical startup looks like that's going public. A year before they're going public, they're about 80 million in revenue, growing anywhere from 50 to 75%, and still burning cash. So that's kind of, just to put it in context, that's the size and scale that's required to go public on one of the US stock exchanges. More kind of from a team and what's necessary to actually go public, you need a great CFO. But I would say almost as important as having a great CFO is you need a great controller, an FP&A function internally, like a finance team and reporting team that can help you navigate it. It is a very grueling process to go through and put together the filing, get the information, right? Your accounting, there cannot be any issues with that, right? You have to be buttoned up and ready to go. So it's a long process that requires a lot of discipline. And for startups, it's hard. I mean, going from a let's grow at any cost mentality and scaling and scaling and scaling towards going and flipping the switch of being like, we need to be very detail oriented in the way we're keeping our books and the way we're recognizing our revenue or costs, tracking everything, and making sure that reporting is bulletproof. That's a big switch for a startup to go through, and it's not easy. And it's a mental one, but it's also a team one where you have to bring in the right people to get there. So that's what's required to make it and go public. Zach, you can give more color on the regional piece and kind of what your experience was with Kareem.
Yeah, no, I mean, obviously everything Joel's touched on comes from, so Joel was actually head of corp dev at Umi in the US when they went public. Was it on the New York Stock Exchange or NASDAQ?
New York Stock Exchange.
New York Stock Exchange. So Joel's been through one of these rodeos and with a very global perspective. You know, to give it a Mena perspective, you know, look, there's basically no precedent of Mena tech companies going public on any exchanges. You know, speaking by and large to bankers both in the region and around the world about the prospects for Mena companies to go public, I think the conclusion is a fewfold, and you know, I'm very much welcome if anybody has any challenges to this to hear it. But generally, people have tended to shy away from thinking about the local exchanges too much. I think the issue has been that there's not a lot of tech that trades on these exchanges. There's none, right? Not a lot of sort of traditional growth companies that trade on these exchanges. As a result, you don't necessarily have an investor base that's familiar with these assets. People don't necessarily know how they'd price and if they would be very liquid. And on top of that, you have a very retail-driven buyer base, which makes it more volatile, more unpredictable, especially for such an unknown commodity. So in general, you know, the startups in the region that have gotten to scale, the conversations we've seen them have been with international exchanges. To an extent, the London Stock Exchange, but the London Stock Exchange also doesn't have a lot of growth stories on it. So even more so with the New York Stock Exchange and NASDAQ in the US. And, you know, I think those conversations have by and large revolved around this one main blocker, right? We've actually seen a lot of emerging market companies very successfully list on these exchanges, emerging market tech companies. And the commonality more often than not is that there's a US comp, right? And by the way, sometimes the emerging market company is better than the US one. Sometimes it has better profitability, better growth, and will trade at a premium to their US comp. But if investors don't know the business model, so when, you know, let's take Kareem as an example, just speaking generically, not necessarily coming from my experience here. But, you know, if an investor has studied Lyft and Uber, right, they'll be much more comfortable. Oh yeah, so
yeah, I was going to say it. There's two IPOs. There's
Fowry in Egypt.
Fowry in Egypt, and Network International went and listed on the stock exchange in the UK. But again, they were both kind of almost institutionalized they weren't pure startup to growth. I mean, they had several kind of institutional investment rounds that made them very different, but interestingly, both in the fintech space.
That's like Brazil. I think you have what PagSeguro and what Stone Payments as well. They're businesses that were started in, you know, more than like 10, 15 years ago in the payment space that went public. So pretty similar parallels to those.
Those guys listed both in the US, right?
US, yeah, NYSE.
Yeah. But they were bigger listings than Fowry. They were like multi-billion-dollar listings. You know, but anyway, just to sort of wrap that up, I think, you know, if you're a ride-hailing business and you want to go public, you know, it's very hard to ask investors to do due diligence on the Middle Eastern market and the business model. So if Uber and Lyft are already public, A, you have an investor base that's educated on your business model. It makes it much easier to go public. And B, you know, I think you are asking less from investors. And C, you're also able to know around where you'll trade. It's not so unknown because you've seen the US guys go out, whether it's good, bad, or ugly, you know who you're going to be compared against, right? So overall, like, look, you know, there are some cases, you know, Network International is a great one where they're actually listing on an major international exchange. You know, Fowry listed locally where there's a little bit less liquidity. You know, it's a little harder to do a major listing, I think, on some of these. But overall, if you want to list internationally, you either better be a heck of a business or at least have some comps.
Gents, thank you very much. I don't want to take up too much more of your time, but I think it's very important and refreshing to see new investors coming to the region and active in the region, especially with international experience. I'd just love to hear, I mean, number one, why are you interested in Mena? And two, what are you interested in, Mena? So if there are startups that are, and I guess three, being cheeky, do you have fresh powder for any startups that are looking to get investment? But ultimately, what has brought you here beyond your previous experiences? What makes it interesting? And what is it that you're looking for in terms of investments?
Yeah, I mean, look, we made 4 investments in the last year, 3 of whom are announced. One will be announced soon, but the announced ones are Invigo, which is an amazing car subscription platform, Doppy, which is a open banking platform. So if you're a fintech and you basically want to plug into the banks with just one integration, you go to Doppy, another fantastic infrastructure company. And finally, Nomad, which is a next generation sort of real estate buying and selling platform, another amazing company. And we have a 4th we're soon going to announce. So we've been putting our money where our mouth is. We're absolutely big believers in the region. I would say beyond that, why are we believers? A lot of it is what we touched on before, right? You have consumers who can afford to purchase, right? There are plenty of big untapped emerging regions like Africa, where you have low e-commerce penetration, but you don't have high purchasing power. In the Middle East, you have consumers that are ready to spend, but you have an ecosystem where very few opportunities are tapped. So quite simply, there's a lot of white space, right? There's $2-3 trillion of consumer spending in the greater MENA region. Only 3-5% of it's online, right? We're going to end up with 25% online. There's a lot of things that have been tried in other parts of the world that have not been tried here yet. A lot of ideas that we see from our, experience in Latin America and Asia, and also back home in Silicon Valley that we're excited to try in the Middle East. There's just so much relatively low-hanging fruit compared to almost any other region. That's what we love about it. And look, we saw from, Kareem that, there is an opportunity to stitch together the region. I mean, Joel talked about there are cultural and linguistic commonalities, there are logistical commonalities. It is possible to build a regional business. And when you can, you're tapping into that massive pool of consumer spending. So it's big. There's lots of untried opportunities, and not a lot of people are doing it. So, that's why we're here. Joel, anything to add?
We are deploying. So if you are a startup, and I think if you're looking for a partner that can help you scale, can scale not only in the region, but also think about what that means even in a greater scope, we're here. I think a lot of what we do, which is interesting.
And just so that you say you're here, what ticket size, what stage, what is it that you're investing in?
Yeah, so for seed, it's typically $1 million and below, and then for Series A, we're looking to lead or co-lead, and that can be anywhere from $2 to $8 million check. And I think the piece that we're really focusing on that we think is interesting and value add for the entrepreneurs is we're providing them with a global perspective on what's going on across emerging markets. When you're working on a problem here in Dubai, chances are there's someone else working on a very similar problem in Jakarta, in Sao Paulo, in Mexico City, in Kuala Lumpur. And what we saw, and Zach can speak this too with Kareem, is you can learn so much both from the things that other startups are doing well and things that they're doing poorly across markets to help you scale, to help you find product market fit faster, to help you execute faster. And that's what we're here to do. We're here to enable that, to help these companies scale and, and go from there.
Great, perfect. There's a question here, but maybe I'll drop it to you by email and send it to you separately if you're able to answer it. But guys, thank you very much. I really appreciate it. I wish you all the luck with the region. No doubt we'll be in close contact and supporting wherever we can to give you opportunities and startups from the region, and we'll get you set up on MAGNiTT with everything that you can have. But thank you very much for your time, specifically Zach, for waking up so early. I think that's awesome. And I think it's really good to see new investment blood in the region with international experience, emerging market experience that can really come and add value. And we didn't talk about what's the landscape going to be like in the next couple of months and next year. That's a whole different webinar in itself. But I think on the specific subject of M&A, it's important for people to understand, and I appreciate your insights.
Thanks, Philip. Really appreciate you having us.
Yeah, thanks for having us, Phil.
Thank you very much. And we'll be sending a summary of the webinar after this by email, and then posting on our website and sharing that across social media. So thank you very much for everybody for having us. And next week, we'll have Khalfan from the Dubai Future Foundation will be joining us. We're turning back on the webinar series. We're doing one a week, and I think we'll be slowing them down to the end of the month. But he'll be talking specifically about some of the solutions that they'll be bringing for startups in the UAE to support with the current environment. Thank you very much, guys. Take care.
See ya.